Welcome, everybody. Welcome back to the Road to Retirement. My name is Chris Anselmo with Brookside Financial and our co-host, Tony Shore. How you doing, Tony?
I am doing great today, Chris. Great to
Good.
be here. And yeah, I'm excited. Summer, a lot of traveling. You just got back from a trip and
I did.
a business trip where you met with some of our nation's top advisors. I know you do that a couple times a year, get together with other financial experts from around the country. How'd that go?
It went well. We had a few good meetings, and it was a little bit of pleasure along the way. Did get to golf one day. It was a really nice course, Jack Nicklaus course, so it was good.
So you
Um,
combine some business with pleasure, right?
yeah, why not?
Yeah. Yeah.
So one of the big topics that came out of it was, with the rise in interest rates, we haven't really talked about how that affected fixed index annuities over the years.
Mm.
And the rates have been so low for so long that they were barely beating CD rates. So last
Right.
last few years there were, the caps were 2, 3, maybe 4%, and now we're seeing them a lot higher. So I thought today I'd first go and tell people a little bit about what index annuities are, and then we'll talk about some rates. So I'm going to try and share my screen. Hopefully I can do this. Let's see. Got that one. So I did do a little window here. Let's see. I don't know if you can see that one. Can you see that window?
Let's
My
see
little
here.
word perfect
Oh,
window.
yeah.
Okay.
Yeah. There it is.
So the basics of fixed annuities are, when you peel away all the layers, what you're really doing, there's a lot of stuff out there on fixed annuities, and it gets confusing. But in its essence, you're just loaning money to the insurance company. So you're making a loan to the insurance company, and it only pays interest. So you can either get a fixed rate of interest, or you can get it what we call an indexed rate of interest. So a fixed rate of interest might be, let's say, 4%, right? So whatever happens in the market doesn't matter. You're getting 4%. An index rate is based on one or several of the indexes, usually the S&P 500. So as the market goes up, you could participate in those gains, but well, we'll talk about you don't have any losses. So what they normally do, we'll put a cap on. Let's say your cap is right now. This is why we're really talking about it. In the last couple of years, caps were 3 or 4%, and now we've seen them as high as 10, 11, and 12%. So what that means, if the index, let's say the S&P 500 goes up 10%, you have a 10% cap, you get all 10%. So your cap, if you have a cap, whatever it is, 8, 9, 10, 11, 12, that means you get the first 8, 9, 10, 11, or 12 of that index. So if the index goes up 20 and your cap is 10, you only get 10. The other concept is participation rates. Instead of a cap, they might say, like, we're going to give you 60% of whatever the index does. So if the index does 10, you get 6. If the index does 20, you get 12. So those are, there's a lot more, but these are generally how those work. You're either going to have a cap or a participation rate, or a little of both. And a lot of our clients will have a fixed rate component in there too. So there might be a bucket where it's paying 4%. We'll talk about that later. And they'll put a little bit in that one and a little bit in the index rate. But at the end of the day, you have no direct market involvement. So you're not getting any dividends from the S&P 500. You're not getting any capital gains. But the benefit of no market involvement is you get no losses. Remember, the number one point on there is you're just loaning money to the insurance company, kind of like you do with a bank. You go to a bank and you buy a CD from Bank of America. You just give them money. You're loaning the money. They're going to pay your interest. Whatever they do with the money is their business. Whether they pay employees, they invest it, they buy bonds, they use it for mortgages, whatever it is.
Sure.
At the end of the day, they're just paying you interest. So
Makes sense.
So in these fixed index annuities, you do not have direct market involvement. So, and a little bit later, you do have limited access, kind of like a CD. If you buy a 5-year CD, generally you don't have any access until the 5 years is up. Usually in index annuities, they'll give you up to 10% a year out without any penalties. And there are early withdrawal penalties if you take out more. Just like if you had a bank CD, Tony, you had a 5-year CD, and in year 3 you say, I want to close it and I want to take all my money out, they're going to charge you a penalty. So
Yeah, and that's a misconception a lot of people have about annuities, Chris, is that once my money's in and I've got a 5-year or a 7-year or 10-year, it's locked up. I can't even touch it. But a lot of them have a withdrawal of 10% a year without a
yeah,
penalty.
correct.
So there is some access, but if you withdraw it early, more than that or
Yeah,
more than whatever the contract states, then there would be a withdrawal penalty. But
right.
um, just like any retirement account, you take money out before 59 and a half, there's a penalty, or a CD. If you take it out before the term is up,
Right,
there's a
right.
penalty. So it's like anything that's going to give you
Eh,
a decent rate that's
right.
low risk. Now, I think you buried the lead in your last point, though, with no losses. So if the market goes up 5%, you get 5% gain. If it goes up 10% on some annuities that have, like, for an example, a 10% cap, you get 10%. If it goes up 20%, you still only get 10%.
Correct.
But the lead here, the main point, I think, of a fixed index annuity is no losses. If the market drops like it did in 2022, you don't lose 20%.
Correct. Correct. So,
So you stay at zero. In other words, you may not gain that year, but you're not going to lose a dime, right? That's the
correct.
thing.
Correct.
Yeah.
So, we talk about it in our first book. I think we call this green money. So it's safe
Right.
money. So that again, if you're going to take out more than the contract allows, whether it's 5%, 10%, then there's going to be some type of penalty. So, but the
Yeah.
penalties are, there's a couple reasons for penalties. One, if let's say you bought a 7-year annuity, well, you told the insurance company, look, I'm going to give you this money for 7 years, and they gave you a rate based on the fact that they would be able to use the money for 7 years. So if you're going to, same thing with the bank, if you were going to give them, if you said, look, I want out of this 7-year annuity in 3 years, well, then they wouldn't have given you such a favorable rate. They would have gave you a rate for a 3-year annuity, right? So the other thing, the early withdrawal penalties, sometimes it's kind of odd to think that they're helpful, but it uh, it cr- it stops that run on the bank, right?
Mm.
So if people are like, I get a penalty if I have to take this, they might think twice about grabbing all the money and running, right? But the nice part, because you don't get any losses, there's really generally you don't see that people are going to cut and run when the market goes down because you're not going to get a loss. So, but then again, you have to make sure you use a good carrier. We want a strong insurance carrier because they're the ones backing the guarantees. In here in Ohio, and I'm sure they have in other states too. So we have this Ohio Guarantee Fund, and I think it's actually with a Y, not two E's. But um, the Ohio Guarantee Fund says, similar to like insurance at the banks, is that you have $250,000 per person per company. God forbid the insurance company went out of business. Now, I've never seen anybody have to use it in Ohio, but if an insurance company's not doing so well, usually they get gobbled up by another insurance company. So,
That covers it.
right.
Yeah, the
So,
bigger
so
insurance company. I read, Chris, that an insurance company, money in an annuity with an insurance company, nobody's ever lost their
yeah.
money.
So, and two reasons. One is that the insurance industry, the regulations are very strict, and they have much more capital demands than banks. So they have higher reserves than banks have. So sometimes it's 3, 4 to 1 that they have in cash in case they have a crisis. So you're right.
Yeah, I think at
Again,
the minimum, I think they have to have 125%
yeah,
of on hand of what they owe you.
right.
So it's like, yeah, they're
So that's good.
regulated very strictly, and banks unfortunately are not. They're FDIC insured, which is
Right,
great, but only up to 250,000, which is the same the state insurance
right.
coffers cover money you have in an insurance policy. So
Correct. So I'm going to bring up another one that I had here. If you could see, can you guys? Not sure if you could see that. Can you? I wanted to show you. So some of the talk at the let me stop sharing and then I'll share again. Some of the talk at the event was, you can see this, is that, can you guys see that now? Okay.
Yep.
So the rates have been so high on the new rates. So let me show you. So I don't know if you could see that well, but can you see me circling there? So
Yep.
so like some of these have bonuses of 18% in year one. And even if you stuck it in a fixed account, say this one with guaranteed income of life, you would get 21.5% in the first year. Right. So there's opportunities out there, and then there's the caps are really high too. So we have cap rates. We see, I showed you what the bonuses are, but we're seeing cap rates of 10, 11, 12%. So where your accounts that were a year or two ago, your cap rates were 3 and 4, which meant, even if the market did 15, 20%, you're only getting 3 or 4. So there's some opportunities now to get out of those products if you're near the end of those terms. And even if you have to pay a little penalty to get out, let's say you pay 1 or 2% to get out of a product that maxes out at 3, but we can get into one that's going to max out at 12. I think that might be an
Yeah.
opportunity, right?
Yeah. Yeah.
So even if you like that one right there, you could have made 21.5% in year one. So that would have made up more than that penalty you came out, and then we could allocate stuff to the market. So there's really some good opportunities out there now with cap rates. Really, the talk was we haven't seen these rates in 15 years. So opportunities knocking, especially for people who have been on the sidelines at the banks. They have several $100,000 sitting at a bank doing nothing. Even if bank rates are up 3-4%, they're not anywhere close to what the opportunity here is in the index world. So
Sure. And people might say, well, that sounds too good to be true, but there's always a they say there's what are the three things, and you can only have two of the three.
yeah, you can
there's growth, liquidity, and I
yeah,
forget the other. But
yes. So
this one, you really, I noticed, to get in those with the added on bonus of 18%, 10 to 18%,
yeah.
those are 10-year
Right. So there,
fixed annuities, right?
there are shorter ones, 5 and 7 year ones too. The sweet spot right now is probably 5 to 7. You obviously won't get a high as a bonus, but I generally don't use bonus products other than if we have to make up some type of penalty. Right. People are like, oh, I don't want to lose 2% to move over. So if you can get a bonus up front to make up that 2% loss, then, and at the end of the day, there are studies that show that bonus and non-bonus products over the life of the product end up pretty even, because what will happen in a bonus product is, let's say they give you a 10% bonus up front, and instead of it giving you a 10% cap, maybe they give you an 8% cap, right? So at the end, again, remember, they're borrowing money from you. They're not going to borrow money at 10%. So generally, over the course of these, we've been looking at these for a decade or almost 2 decades. They've been averaging probably 3 to 6% over the life of the annuity. So if we can grab some higher rates right now, and I do have another slide. I don't know if I could bring this up. I'm gonna. So I created a spreadsheet. Believe it or not, being the
I believe that.
being the CPA.
You're the king of spreadsheets.
So
that's the CPA in you,
yeah.
right?
So what I did is I took the S&P 500 for like the last 20 some years.
Mm-hmm.
See if I can see this. I don't know if you can see this. Okay, so here's a chart, the S&P 500, what it's done over the last 20 some years, right? And all the way to 2023. So the chart that we developed was, if you could put in a cap, let's see if I could get you to see this chart, right? So this chart's interactive. So the red line is the S&P 500 from 2000, it dropped 2001, 2003, then it started going up. Then we had the housing crisis, and started going up again, up again, up again, and then we had some pretty good years while our ex-president was in office, and then COVID hit and all that kind of stuff. So that kind of took it down. So the green line is what an index annuity would be. So you could see, as when the market goes down, it just stays flat, And as the market starts to creep up, it starts earning a little more interest. So let me show you. This is kind of interactive. So if we could change cap rates. So if you had a cap rate, I had a little thing here. Let's see if I can go up there and change my cap rate. So if you had a cap rate of 3%, which we've seen lately, you can see that this chart, this chart doesn't look so great, right? I mean, the S&P really outperformed that chart, that green line. But if you can get a cap rate of even 6%, then this chart looks getting closer, that the green line without taking the risk is approaching the S&P.
Yeah.
And
That's much better, especially
yeah.
considering there's no risk.
And if you could get a
Or
cap
not the
rate
same
of
amount of
even
risk.
7%, it's pretty darn close that they would break even, and you didn't have to go through all these ups and downs of the. I don't know if you guys could see that.
Right. Well, the
All the
key
ups and
here
downs,
is
right?
look at how close you are with your principals protected.
Right.
And
So
in that S&P 500, your principal is not protected. It
and
could drop. It could drop.
correct. And I think what this doesn't show is the emotions of investing, because the S&P, you would be here in the S&P if you had the guts to stay in. When the market dropped here, a lot of people got out. So then they
Yep.
didn't get these 3 or 4 years that went up. And then there's like, oh, it's going up, it's going up, it's going up. Let's jump back in. And then it crashed. They're like, I'm not doing that again. And then they missed this ride all the way up to here. And then it crashed again. They're like, oh, I can't take, I just can't take that emotion. So the red line's probably even worse than for the average investor, because they didn't stay in to get all the ups, right?
Sure.
So the nice part about the index,
Or they stopped adding to it.
Right.
A lot of people, in 2022 said, I'm going to stop contributing to my accounts that are in the market, like my 401k or whatever, because the markets I lost so much money. So then they lose money and they stop contributing, which compounds
Right.
it compounds the negative effect, because look at what they miss out on.
Yeah. So this was a pretty good run right there, and you'd missed out. So you could see as this went up, like you didn't get that. So that went up. Some of these rates went up 20%, and this, when you have, remember we tagged this as a cap of 7, you got 7 instead of 20, but you didn't get
Right.
any of these downs. So for a lot of people, for at least part of their money, safe money, sleep easy money, we use this to kind of level off the emotions, right? So if you were in this and the market dropped in 2008 40%, and you didn't lose a penny, you're like, I'm okay, right? So now again, long term, the market's going to beat it, but you have to be able to take the risk of the market, right? So I mean, we've seen caps, and I'm saying you're going to get a cap of, let's say you put a 12% cap in, which isn't, I won't say realistic, but if they're not going to have caps 12% for every year. But if you had a 12% cap, then this one's much higher, right? Because if you could take out all the negative years and in positive years, you earned up to 12%. So 12%, I'm just saying 12% isn't realistic over the whole life of the product. But while these
Plus
rates,
you lock in your gains and then you
right,
stay there. That's your new floor. It doesn't go down. The floor doesn't drop ever.
So while these rates are here, I think we should try to take advantage of them. So
yeah, it makes perfect sense. But you're not saying, as some people might say, well, why don't I put all my money in that? But you never want to put all your eggs in one basket. That's not smart.
correct. So I just moved that over so we could change it. So if you
Plus liquidity, you might need more liquidity. So you can't put all your money in there, but you could put a chunk of it and keep that safe from the market volatility. Is that what you're saying?
Yeah, because the market, you don't have any market volatility. Remember, on another slide we said, look, this is you don't have any market ups and downs. So I mean, you'll get some of you're not directly participating in that market. So when we showed that other slide, it said you're not going to get capital gains, you're not going to get the performance, but you're just at the end of the day, they're just paying you interest. So So for part of your portfolio, either I want to say dead money you have sitting, like we have some clients come in two, three, four, $500,000 sitting in the bank in cash. And I said, look, unless you're writing a ransom letter, ransom demand for your grandchild, you don't need $400,000 sitting in the bank doing nothing. Right. So
Yeah.
leave 100 in, but, there's something called opportunity cost for us listeners. Like even if the bank would pay you 3% and you're getting zero, I mean, 3% on 400,000 is $12,000 a year. So by parking that money somewhere that's earning nothing, you're basically giving the bank $12,000 a year to hold your money. So,
Yeah.
and a lot of people, what do you mean? I didn't give them anything. You did, because if you'd have had it somewhere else, it could earn some more.
Yeah, it's opportunity loss. I mean, you can't have any significant amount of money is somewhere where there's absolutely no gains. I mean, that's just not a good idea.
So, so that that was a big topic of discussion at the seminars. It was, look, we haven't seen these type of rates in decades. So go out, tell your clients, look, if you have some what we call green money, or you want to make money that safe type of investments, go out and grab these interest rates while they're out there. So
yeah.
And again, there's all flavors, right? There's 3-year, 3-year rates probably aren't too good right now, but 5-year, 7-year are probably the sweet spot right now. I don't really like to use 10-year products unless people are like, I don't mind that. 10 years is fine. I'm never touching this money. So if you're really not touching this money, why don't we grab the best rate we can get? So, that was a lot of what the discussions were about at the seminar.
I bet with interest rates where they're at, you have to take advantage. And there's been so many changes. You got to do something to keep up with inflation, but yet,
So again,
minimize the risk.
The opportunity is for money on the sidelines right now, or money that's in fixed index annuities. They're probably near the end of their term. So let's say you had a 7 or 10-year one in your last year or two, and it's going to cost you 1 or 2% to get out. It might be worth getting out, just because the fact that, look, if you're stuck in that account that's going to earn 3% for the next 2 years, and you could go into an account that possibly can earn 12% for the next 2 years, you may be better off jumping ship. So, or like we said before, use one of those little bonus products to give you a little upfront. Now, you don't have to get the highest bonus. So, you trade off bonuses. The higher bonus you get, then the lower the caps are a little bit. So maybe you only need a 5% bonus to make up your losses. So,
well, how can our listeners, Chris, if they want to find out more about this, how do they get a hold of you? There you go. For our viewers, it's on the screen. For our radio listeners and podcast listeners, let them know how you can get a hold of you.
So you can call us at either 440-886-3550. You could go to brooksidetax.com. We also have a calendaring software. So if you want to make an appointment, you can actually just make an appointment through that system. And I don't know how it all works. It's like magic, but I think Aaron does all that stuff for us. So, and then we have some, also we're on YouTube. That's where some of these podcasts are at. And we also have Facebook, and we got a lot of stuff going. I don't know any of that stuff, so I just pay someone to do it. But and they're much better at it. You pay people to do stuff that you're not good at, right? So
right.
Like
financial advisor. That's why you need a financial advisor.
I mean, and there was a study by Fidelity not too long ago that people are always worried about paying for financial advisors. There's a study that shows that financial advisors probably add 3% to the overall return after fees. So, the real crux of paying someone is you need handholding when the market's choppy and, like if the market's booming, you don't need the handholding as much. Like I always say, you only start screaming when the roller coaster goes down, right? So that's when you need the financial guy or girl.
Yeah,
so.
that's a good analogy, Chris. Well, great show today. And again, listeners, pick up the phone, give Chris and the team a call there, set up a consultation. There's no cost, no obligation to talk. get a consult, see where you're at, see what might work for you. And everybody's situation is different. Chris and his team will look at where you're at and all the different factors and help you get a plan in place for your finances right now, or especially to plan ahead to have that money you're going to need in retirement. That's what it's all about, isn't it, Chris?
Yeah. And stay tuned. We'll have another podcast next week. And Tony and Marlette does some during the week. So stay tuned. Look at our YouTube channels, and I think Spotify and some Apple Play, all those.
Yeah, Apple Podcasts, Google Podcasts,
Right.
Spotify, Amazon Music, and Audible. You're on all the major podcasting sites.
Okay. Wow.
So just look up Road to Retirement, The Road to Retirement, or Brookside Tax, or Chris Anselmo, and you'll find us.
All right. Thanks, Tony.
Yep. Great show. Thanks, Chris. Thanks, listeners.